I am going to show you how to identify certain types of liquidity. So once you see them, you know what the market is intending to do. So I'll be writing them down. If you have a pen and paper with you, you can also write. So we are come to talk of what we call buy-side liquidity. And with the buy-side liquidity, we are going to look at equal highs and double tops. So that's the first one we'll look at. Then the second one we'll look at is sell-side liquidity, also known as equal lows and double bottoms. So let's look at them. So let's start with buy-side liquidity. What do we mean by buy-side liquidity? Let me explain something. Assuming this is resistance, and like you know, I usually use the color red for resistance and the color green for support. So let me change this color to red because it's resistance. And let me draw another horizontal line here to signify or symbolize support. So I'll change this color to green because support is green. So because this is resistance, you know, at resistance, price gets rejected and it drops. So let's say price is coming down like this. The market is coming from above, like rain. It finds support here. Then it starts to go up. Let's end it here. Assuming you entered this trade, you bought down here, or assuming you bought down here, let me use an arrow to indicate what I mean. Assuming this was where you bought, because you know that it's a support level, and probably you saw a what do you call it? A candlestick pattern that suggested to you that price wants to go up. Now, once you are buying here, you must have a target. And the target, because you are buying at the bottom and the price is going to move up, the target must be on top. It must be above. Okay. So how do you know where it is likely to go to? You have to identify where the liquidity is. And that type of liquidity is what we refer to as buy-side liquidity. Why? Because it's at the top. Once you are buying down here, you want it to go up, so you make profit. That is why we call it buy-side liquidity, because the liquidity is on what? The buy side. Now, there are various forms of liquidity, like I've been saying. There are 5, but I'm going to teach 2. So let's look at how buy-side liquidity looks like. Once you buy here, the liquidity you have identified must be your target. This is how it looks like. Let me explain. Okay, I think I can take this off so I can create some space. So we are talking of buy-side liquidity. So let me do another illustration here to show you how buy-side liquidity looks like. First of all, we are going to look at double tops. Now, this is how a double top pattern looks like. It's actually a pattern that is taught. If you read retail trader books, it's a pattern that is taught, and retail traders are usually taught to buy or to sell at double tops. It works some of the time, but most of the time it doesn't. The reason is double tops are nothing but traps. And I'm going to explain why. This is how a double top pattern looks like. I want this to be very, very practical. So let's say the market is doing this. Then it finds support here. It starts to go up. Okay. It's going up. Then it does something like this. Let me stop here and then show you something. Now, this is an old top. This top you are seeing over here. This is another top. Very good. So now let me continue my illustration and explain something to you. So let me extend this support line and extend this resistance line as well. The market keeps coming down, comes to find support here once again, continues going up. Now, once it gets back to this level, okay, the conventional knowledge out there is you should be looking to sell here. At this point, you should be looking to sell over here, because this is a top, and you know that tops are resistance or highs. You can call them highs, tops or highs. This is a top, this is another top. So we have a double top formation. So the conventional knowledge is that you should sell over here. Now, this is why it's a trap. The market makers know that retail traders will be selling over here. at this double top level. They know very well. Okay. Now they also know that if you are selling here, you have your stop loss above. Now the stop loss, the purpose of the stop loss is to prevent you from incurring a big loss in case the market reverses against you. You are selling, but in case the sell doesn't work and the market starts to go up, the purpose of the stop loss is to take you out of the trade so you don't lose plenty money. They know that anybody who is selling here and will use a stop loss has his or her stop loss above where they are selling. And it's usually a range of 10 to about 50 pips. But some people, especially swing traders, have big stop losses. You can find a swing trader who has a stop loss of about 100 pips away because the trade is a long-term trade. That is why he's doing that. But the majority of people who will be using stop losses have their stop losses within a range of 10 to 50 pips above where they sold from. So what do they usually do? Their intention is to move the market down. But because they know that a lot of people are selling here, okay? A lot of people are selling here. What do they do? That's what I'm saying. Some of the time it works, the double top formation, but most of the time you realize that you get stopped out. You realize that the market keeps going up. They continue to move up. They break that double top formation. They continue to move up. And then clear the stop losses that were placed above this very zone. So those stop losses is the liquidity because that's money resting over there. Because if you are selling, they have to buy from you. Do you understand me? When you sell, the market has to buy from you. So if you are selling here, they move the prices up because they know that people have their stop losses placed above here. So they have to hit all those stop losses. Hit all those stop losses. Then once they are done clearing all the stop losses that were placed above over there, they now what? Fall. Now this is what they do. Two people are affected. People who have their stop losses above here. That's people who are selling on this double top formation. Get their stop losses hit. And also those that were buying, they had buy stop orders. Now a buy stop order means you are buying at a higher price than the current price. So let's say if the price was roaming around somewhere here, some people decided to place buy stop orders above it. Those are breakout traders. So they move and hit those people who are selling, who have their stop losses above, and then trigger the pending order of people who have buy stop orders over here. Then they move up a bit, making those who have the buy stop orders feel that the trade is moving in their favor. Then before they realize, they start to drop. That is when the sell actually starts. So this is what happens. By then they would have taken out anybody who sold there and had the stop loss within this range. And then if you are buying over here, if you had a buy stop order over here, they would have triggered your pending order and then gone up to make you feel that the trade is going in your favor. Before you realize, it starts to come down. It comes down back to your entry and then runs you into a loss. Now, if you are buying over here, your stop loss is probably below here. So it will come down to what? Hit your stop loss. They have already cleared those who are selling. So now they are coming to clear those who had buy stop orders. So they clear them and then they what? Finally move down. That is how they do it. That is what I'm saying. What do you call it? Selling at double tops is very risky. A few of the times it will work out and you'll be happy. But most of the time it doesn't because they usually have to clear the liquidity that is resting above here. So take note of that. I'll be showing you examples on the live charts very soon. That is what I mean by what do you call it? Double tops. Now, one thing you realize is that most of the double tops usually have highs that are almost equal. I will be showing you that. Let me just illustrate that right now so you can see. Assuming this is a high, okay, I'm just using, okay, I think I should use candlesticks too. Let me do a candlestick illustration so you will understand it much better. This is our resistance level. Once again, let's change the color to red, okay, and then this is our support level. Once again, let's change the color to green. Let's say this is a candlestick, so it's a bearish candlestick. This is a candlestick, and it has a wick. This is its wick. Candlestick. Let's say there's another candlestick here. The color could be any other color. Let's make this one green, a bullish candlestick. Let's give it some wicks or shadows as well. Our bullish candlestick. my wicks may not look very accurate. Pardon me. When I'm drawing the wicks, I usually have trouble. So look at something. We had price doing this. That's to see that initially the market was out. As far as this session, this compartment is concerned, the market was bullish. Okay. Then, of course, it came down after this candle formed. The market came down like this. Then it started to go up again. Of course, it found support over there, so it started to move up again like this. Let me shift it here so it will look like this. Okay. So it started to, please pay keen attention. When I finish, I will explain it to detail. It should look nicer than it's looking right now. Let me make it look nicer. So I would have to move this one over here and then move this wick over here. Now I want you to look at something. So this is an old high, okay? And this one has also formed. This is an equal high. It's almost the same as the double top formation. You realize that the wick of this candlestick and the wick of this candlestick are almost on the same level. Now they don't have to be equal, exactly equal. But the difference shouldn't be massive. It should be marginal. Sometimes you have the wicks different a little in terms of the levels. You realize that one is a little bit higher than the other. We still consider it. But if the difference is too much, that is not an equal high. So this is how equal highs look like. You realize that this high and that high are almost at the same level. They are almost at the same level. So assuming this happens, and then the market comes down, comes to find support over here again. Okay, comes to find support over here again, and then starts to go up. Then it runs into these equal highs. Please don't sell over here. These equal highs, they usually run into those equal highs and then go above them. If eventually they'll come down, but they have to make sure they clear people. So the equal highs are almost the same as double tops. So realize that the highs are almost equal. If you see something like this and you see price approaching that level, never think of that level as a place where you want to sell. Because when you sell sometimes, a few of the times it will work for you, but most of the time they run above those highs. We call it a raid. So they raid those equal highs. Raid, like that insecticide spray. So they raid those equal highs, go above a little, then clear people's stop losses before they eventually drop. So take note of this. Equal highs like this, liquidity is resting above. So they have to raid that liquidity. We call it a raid on liquidity. They have to raid that liquidity, clear those highs before they drop. So this one is almost the same as a double top formation. Let's go to live chat and see if we can find some examples, which I believe we would. I think this is a Euro card. I want us to look for examples where equal highs were raided. I think I've found one here. Now look very, very carefully. I'll have to be zooming in and zooming out interchangeably so I can explain certain things. Now, I can clearly see, was there support over here? I think there was. Let me zoom in and then look for the support level so I can do my analysis. I can do my explanation very, very well. Because I see a very nice example here. Okay. So it pushed down like this. Yes. There is another form of liquidity here. We call them gaps. So they found this is a support level. They found support over here. Now the support was in the form of a gap. Once they close those gaps, they always have to move far away. I saw a really good example. This is where I saw it. Let's look at it. Let's look at the example I was talking about. This is it. An order block, what we call an order block. So in actual sense, this is the support level, a bullish order block. I'll be teaching that one too. So they found support over there. Now, some people, look at this. Look at these highs, these highs. Look at these highs and look at these highs as well. Look at them very carefully. Don't you see that they are almost on the same level? Let me make it look bigger. Let me place a horizontal line there so you see. Look, they are not exactly the same, but they are almost on the same level. So, like, the difference is very marginal. It is still considered as equal highs. Now, this is 4-hour chart. So, if you go down to smaller time frames, like 1 hour, 30 minutes or 15 minutes, you see this form, this equal highs, form as a nice double top formation. Now, since it is forming as a nice double top formation, let us extend it over here. Let's do this analysis, assuming this is yet to happen. Let me highlight. And then, so if you bought somewhere here, okay, let me place an arrow there. Because you saw that price came back to a support level. If this was where you bought, where I have this arrow, if that was where you bought it, you should be targeting this place as your profit, your take profit level, where I have the horizontal line, because they are equal highs. So we don't look at equal highs or double tops to sell. We look at them as profit targets. So if I bought down here, it will be my short-term take profit level, because I know that that is where the liquidity is resting. So that is where they are most likely to move towards. Now, you are a much better informed trader, so you know that these levels are traps because there's liquidity resting above it, because it's an equal high. Now, a trader who is not very much informed will rather be looking at those equal highs as an opportunity to sell. So whilst price is moving up here, he has already seen or identified these equal highs or double tops as a resistance level where he would like to sell at. What he doesn't know is it is a trap. So look at what they did. They moved up. You see what they did? They moved up. So if you are selling here, if you sold right here, you had your stop loss. If you are definitely you have your stop loss above. So in case the market decides to go up, you don't incur a big loss. Your stop loss takes you out of the loss, and your loss is not very big. So those people who are selling here have their stop losses above. Now look at how they ran prices through. So let's look at the range where they moved up before they came down. Let's calculate the pip range from this place where people would have been selling to where they moved up to. So they moved up about 120 pips. I don't think you have a 120 pips stop loss. Unless, of course, you are swing trading and then you decided to trade with very small lot sizes. If not, a 120 pips stop loss can blow your account if your lot sizes are big. So you see, anybody who sold on this double top or equal high formation got taken out. That is why these things are risky. Anybody who sold over here got taken out. You see, they moved out nicely and then hit anybody who had their stop losses above here before they drove prices down, and then they continued going. Now, the only reason why they came down to this level is because you can see that there's a break in market structure over here. I think you should watch that video over and over and over again. And this is a classical example. So if we are selling over here and you had your stop loss above, you would get taken out. So after taking them out, they came down to find support on this break on market structure, which is a previous swing high. Then they continued going up. So please avoid double tops and equal highs. If anything, they should be your profit level. So if I was in this trade, this place would have probably been my take profit 1. So I don't sell at double tops. I always wait for them to clear them. Then when I get a signal, I then sell.